Here we go. So, now I want to show you a picture of comparing now to 1973 and 74. And you can see, although this feels like a very unusually great rally, you can see that it is following pretty much the path that we had in the 73 and 74 recession. And then we came back and the stock market did about the same thing it has done right now. It feels like the best stock market any of us have ever seen. And it really is very similar to the one they had back then. Now, you can see how shortly after this point, the stock market turned down. I'm not suggesting that this means that it's going to go this way now, but I want to point out what those people must have been feeling like and how optimistic and positive they must have been feeling when they got to the point where we are now, and you can see what happened to them next. So my whole point is, don't go by what we've been in. We, human beings, have the job, if you want to make money on Wall Street, of staying away from your natural evolved tendencies because they're not really made to allow you to make money on Wall Street. You see, we are evolved to look for patterns and especially to expect things to go forward exactly like they did in the past. That's because we come from a world that changed very slowly. Remember that it's so clear that that's part of what human beings do because we're the only species that really learns from the past and builds on what our parents did and what our grandparents did, and we keep getting better and more evolved, and we do it societally. Every other species is still doing it the same way for thousands of years at a time. They don't really learn and move forward. So this is why we, the human race, we're weak, we don't run fast, we have lousy teeth. In every way, we are inferior to other animals. And yet we dominate the world because of that one ability to think, but then to take what we learn and add to it and get better. We have that tendency. It has had tremendous survival value, and the human beings who didn't have that very strong tendency didn't make it. Their genes were not passed on. And yet, it does a terrible job for you on Wall Street because things change very rapidly. It doesn't work very well. You have to get past that need to believe in what has happened in the past and extrapolate. And that's the only way that we're really going to be able to make any money here. And so the trick isn't to always think it's going to be different from what happened yesterday. It is to be independent, not hypnotized, and to be thinking things through all the time. And let me go to my next picture and see what it is I want to show you here. Oh, okay. So here's the point. Given that we have all these reservations, why do we feel comfortable? Why do I say that we're still in the middle of a bull market? Well, I talk a lot about the market X-ray, and what I'm really looking at is beneath the surface. I learned how to do this as a kid. I used to spend a lot of time on the New York Stock Exchange as a kid where they have specialists. This specialist always makes money because while everybody else sees the buying and the selling, everybody else sees one buyer and one seller, and they see the stock price, and everybody tells you the price is the thing. Focus on the price. That's how you know what's going on. Wrong. In fact, but what's really happening is that specialist could see what was going on beneath the surface because he could see the order flow. He could see that there were 4 or 5 buyers for every seller because that's who was screaming around his post. So he knew that if there are 5 buyers and 1 seller, he wants to be on the side of the seller. He wants to get in there and buy it because that stock is going up when there are way more buyers than sellers. Being able to see that gives you the insight that you need to know what to do in real time. It doesn't predict. It tells you what is going on really right now. It interprets for you and helps you analyze what's going on right now. So what I'm showing you now is a picture of what is happening right now. It's averaged out a little bit. It's not minute by minute, but it is showing you over a period of time. The black is it's actually dark. The black is the demand, which you could call buying power. And the red line, which is declining, is supply. Those are the sellers. And I talk a lot about how we analyze the buyers and sellers separately, just like that specialist could do on the New York Stock Exchange. He could see that the buyers were people who wanted to assume risk. That was one type of group. The sellers are generally people who are trying to reduce risk. It's a different kind of a group. They act differently. They have different psychological way of behaving, and they have different hormone secretions. One guy could turn into the other guy, but when they do, they behave differently. They're acting differently. Now, one of the things I want you to know is this. Through all of the time that I've been studying this, and I've gone back and looked at maybe close to a century of the way this works, there has never been you never started a bear market without this red line actually turning up and going up for several months or even a year or more before the market rolled over. You don't go directly into a bear market. You go into a place where people are now more willing to sell. But as you can see right now, the willingness to sell, the supply is on the decline. It's getting worse. It's getting lower. People are less and less willing to sell. That is a very early stage in the bull market. So every time we make a new low in that red line, it tells me that there's at least another 3 to 6 months of bull market left, and possibly more. Every time you hit a new low. Well, we just hit one about a week or so ago. So while I see in the short run that demand is waning and supply is picking up a little bit, I know that in the long run we're going to have people willing to sell for weeks, for months, before we really roll over into a bear market. So. And to show you how that looks so you can understand the context, remember that horrible recession that we were having. It wasn't, and a bear market that we had in 2000, 2001, 2002, all the way until March 2003 when that new bull market started. And notice here in the May period, notice that it's exactly the opposite of now. You have the sellers getting more and more desirous of selling. The red line's going up steeply. And the green line, the guys that are willing to buy, that's going down. And so that is what it looks like. That's called hell. That's a bear market. That's what it looks like. Exactly the opposite of today. But I want to show you how it morphed in, because you notice that eventually in July, the sellers changed first. And it didn't turn into a bull market yet, but those sellers started selling in July of 2002. And so you could see that their desire to sell was gradually declining, but the buyers were still going down. The demand was still declining. So the bear market continued. There were some attempts. You could see that in September when a little bit of buying started, and in July it felt like the beginning maybe of a bull market, but it wasn't really there yet. But you see those sellers, they changed their behavior early before you really morph into that bull market. And then eventually, in March of 2003, I remember that day so well. That was the beginning of that bull market, and I remember it so well because it was on a Saturday night, I woke up, and it was about 2 o'clock in the morning, and I turned on my Friends on Fox, and I was watching the news, and it was the night that we attacked, the United States attacked Saddam Hussein. And at the time, the information minister of Iraq was saying, we're going to teach you a lesson you're never going to forget, and they're not anywhere near the airport. And the generals were on television saying there are not enough boots on the ground, General McCaffrey. And I remember watching a television package. It was a little filmed package there on the news, and it was showing these people in New Hampshire in the snow covering their house with duct tape and plastic because they were afraid of being gassed, and I was laughing about it. And my wife actually woke up, and I said, you know, this is about as crazy as it gets. This has to be the bottom, because that was a long bear market. And I said, I'm going to go and I'm buying stocks on Monday. And sure enough, I went in and I bought about probably $20 million worth of stocks on Monday. And you see where the selling is going down, and look at that period in March where suddenly the buying went up. That's how I knew after that initial purchase that it was worth it to continue, and that I knew that this was seriously a bull market, because you see how not only do you have the sellers declining, but now the buyers are actually on the way up. Demand is rising. So that's how it looks, and it is because of analyzing what is, it gives me some insight into what's going on, and it doesn't make me a fortune teller. It doesn't make me be able to predict the future as much as it is being able to read what's going on now. And what is going on now is we still have demand becoming stronger and supply in general, in the long run, weakening. And so we have at least several more months of bull market. That means we will hit new highs. Let me tie this for you into a forecast of the economy. That's about reading the stock market. Now let me talk about reading the economy. These are leading economic indicators. They're simply calibrated. We get all these different economic data from the government, from all over the place, manufacturing reports and unemployment. Some of them are about what happened in the past, like unemployment. They don't help you forecast. Some of them help you forecast, like how much money is being pumped into the banking system and things like that. The green line in the picture that I'm showing you now is the picture of what people are going to be experiencing and feeling 3 to 6 months in the future. And the blue line is where we are right now. And you can see at the end of the line, you can see how the blue line lags the green line by 3, 4, 5 months, around that. And so you can see what people are going to be experiencing by watching that green line. And you can see that that turned up. Now, back in the summer, when everybody was actually talking about a double dip and worried about the double dip, what we were talking about in the summer and saying, if you were following us, was that the surprises are going to be to the upside and into August and into September, that the surprises in the economy are going to be positive surprises, and eventually that's going to work its way into how people perceive the economy. And sure enough, that is what has happened, and you notice that the blue line has started to move up. The one thing that gives me a little bit pause here is that the green line you see right now, it may be starting to level out and roll over a little bit. And that might show some moderation. Now, these things have to continue for a while. You can see, if you look back there, that they do fluctuate a little bit. They do move around a little bit. So I'll have to see this sustain for a while before I really use it to forecast. But right now, you can see that it is beginning to level off, and that's something that you would see around May or so. And the sense that people that are listening to me now have, and a lot of you have told me that you're concerned about the stock market and potentially rolling over. Think about the fact that we are, here we are, where all the surprises are to the upside, and people are becoming now more and more positive about what they're seeing and believing more and more in the U.S. economy. And this is people around the world. And that's why they're pumping money into the U.S. economy. Well, as the surprises go to the upside, and here's actually another very interesting picture. This is made by my friend Anirvan Banerjee at the Economic Cycle Research Institute. Very, very accurate think tank. And what he's showing you is the red line is home prices about 3 or 4 months from now, and the black line is home prices as you're experiencing them right now. And you can see that he's forecasting increases, that the price of homes will actually start to rise. People are not yet discounting that. They don't know this is going to happen yet. You do, but they don't know it. This is going to come as a surprise. It's going to feel very good to people, and they are going to feel more and more optimistic. So now putting the last picture back with this picture, imagine as everybody is just starting to really believe in the economy, and actually it really does at that point start to level off a little bit. That doesn't say it's going into recession. That's the rate of growth. But it starts to level off some. And of course, what happens then? They get disappointed. That may be where you get that big correction you're looking at. And hopefully by that time, May, June or so, that may be when the inflation scare in the emerging markets may have gone away. Those stocks may be down a lot by 30, 40, 50%. They're already down 15 or 20. And so if you're asking when will it be time to move into those, I don't think it's time now by any means, but that may be a really good time to do that. At the time when we start to be seeing that maybe our growth is moderating and it's not going to keep accelerating, and they are ready to start letting their economy grow again. And remember, those places for the next 5 or 10 years are going to, on average, 6, 7% growth. They're going to give the world a 4, 5, 6% average growth rate. They will be growing between 6, 7, 8, 9, 10 or more per year. There, that spread of the middle class is happening, and it will continue to happen for the next 5 or 10 years. But they want to do it while protecting themselves from inflation, and so they're going to back it up for a while. That's what we're seeing right now.